All right, so we are in the third section of the chapter. We're talking about selling stuff. Stuff meaning merchandise. Stuff, merchandise meaning inventory. And so when we sell stuff, we sell it for, of course, hopefully a much higher dollar amount because our COGS, or our cost of goods sold, is that looming issue. Before we actually do this one, I actually just want to talk about all of what you see up here, okay? I'll draw it for you, though, so we can talk and see it all at once. Hang on a minute. Five two was all about buying stuff. The section we previewed yesterday and we're going to actually do today is all about selling the stuff. There's two ways to buy and sell. We could use cash to do all of it, or we can charge it. With that comes some kind of terms. We'll talk about terms here in just a moment. When we're the one buying stuff and charge it, it all has to do with AP. When we're the one selling it and letting our customers charge it, it's all about AR. Terms. There's typically some shipping terms, and there's oftentimes some kind of discount terms. Like if you pay within, we're going to offer a discount. Okay. On the buying side of things, it's all in inventory. Inventory, of course, is an asset. When we acquire the stuff, so when we buy the stuff, it's a debit. If we return any of it, it's a credit. And in those, I physically can see. I can see the stuff coming to me. I can see the stuff leaving me. There's some stuff, though, that we really can't touch. If we have to pay for the freight in, so if in this case it was FOB shipping point, it's free for the shipper, not for me. That actually drives the dollar amount of inventory up. If I pay my bill early, that actually drives the value of inventory down. All in inventory. Some of you like this, that it's all just right there. I just know it's inventory. Is it up or down? Some of you, it's very hard to grasp that. Now, when we go to sell stuff, we're looking at revenue, which is a credit-based account that basically overall impacts the owner's capital. So when I sell stuff, it's all based on revenue, but then when we have all these players in there, there's all these contra revenue accounts. Do you guys remember them from yesterday? You guys remember them? Sales, returns, and allowances. So when I sell and I make money, that is the dollar amount. Like, hello, there is the dollar amount. We're not going to offset it like we do in inventory. We're going to offset it completely with what are called contra revenue accounts. So if something is sold, and they all have debit balances because they act opposite of revenue. If they return something, they meaning our customers, that's going to be in the contra revenue account. What was the other one? Yeah, it had to do with discounts. I just want to make sure I get the right name. Let me look. Is it sales discounts? Yes, it is. Sales discounts has a debit balance with, again, it's contradicting. If we're going to let that AR pay sooner, we're not going to let that affect our revenue. Rather, we're going to offset it in a contra account. So do you see how this is much more involved, but yet everybody's in their own camp versus the plus and minuses that impact inventory? Let's try this. Remember, anytime we see sold, we know there's two transactions. Anytime things are returned that were sold, two transactions. Are we selling on September 6th? We are purchasing because we need to purchase stuff before we can sell it. Town & Country cannot sell Under Armour sweatshirts if they haven't bought them yet. I suppose they technically could, but it gets a little messy. Okay, so if we purchased with cash 80 calculators at $20 a piece, what did we gain when we bought calculators? Is it called the calculator account? Is it called the stuff account? Or is it called the merchandise account? No, it's called the inventory account. Assets are increasing because we bought 80 calculators at $20 a crack. How do we pay for them? We are the retailer buying from a wholesaler. Cash. That's easy. Are we going to end up owing them any money later or paying and getting within a discount period? No, because the cash is on the table. So cash is our credit. Could it have been AP? It could have. If it would have had the whole terms, 210 and 30, FOB, shipper, all that business. Okay, do you think we're going to keep all the calculators? My guess is not. We'll see. What happened on September 9th? We paid the freight on the calculators. So was it FOB shipper or FOB destination? Who was it free for? The shipper. In this case, it's, I think, Guthrie. Is it Guthrie? Is that who we bought them from? So they must have said, even though you're paying cash for these things, we're going to ship them to you, and you have to pay the bill. Okay, when we pay for shipping, when we're buying from someone, what's our debit? What's going up in value? Inventory is going to go up by $80, and cash will be reduced by $80. And what I do here, because it doesn't say paying for shipping, it doesn't say that it's inventory, I would put plus shipping. Just so you remember, oh, yeah, we didn't buy $80 more worth of calculators. We paid $80 for the calculators to get to us. So I would just put plus shipping somewhere there. Just so we don't forget that. Because could it look like we bought $80 more of calculators there? It really could have. What's happening in the next one? We returned 3. Why? Does it say they were defective? We didn't like them. They weren't up to our standards. Okay. What's going to go down this time? Inventory is going to go down. Let's think about, how did we pay for these things originally? Does everybody give you cash back? A lot of times you get what's called store credit, okay? That's what they did there. They gave us store credit. I'll come back to that in a minute. Inventory went down. We are now $63 less for calculators. Well, wait a minute. Why $63? How many did we return? Okay, I thought we bought them for $20 a piece. So why are we actually, shouldn't it be $60. Keep reading. That includes the freight because remember we got them shipped to us. So if I had to tell the inventory story here, it was 1,600 plus 80 minus 63. And that 63 is including recalculators and shipping. Now, couldn't those little rascals have just given us our cash? You guys, we originally paid cash for both the stuff and the shipping. Could this have been cash? It could have. But most retailers, and think about Target too. Target's the same way. Oftentimes they're going to hand you a gift card. And it's their, you could call it manipulative, but you could also call it good business. They want you to come back. And so they force you to come back by not giving you your cash back and giving you a gift card or store credit instead. Now think about this from an accounts payable. Accounts payable typically has a credit balance when we owe. Now, if we owe, we've got a debit offsetting that credit. Does that make sense? So store credit is should actually be called store debit, really, because they've given us a debit. In other words, we've got $63 sitting there in a little kitty to use the next time we go buy from them. Now the bigger question is, did I say, I didn't even read it. Return 3 calculators to Guthrie for $63 credit. But what's confusing is that's actually a debit. But if they had credited AP, that means we owe. No, now they gave us kind of like a gift card, if you will. All right, we finally get to start selling stuff? Yes. We sold, I see sold. How many transactions are we going to have? 2. Because we got to get the stuff out the door and then we got to say, well, what did the stuff cost us? We sold 26 calculators that cost us $21, including the freight, for $31 to Lee Bookstore. Terms and 30. How do we already know how Lee paid us? Did Lee pay us in cash or did they say bill us? Okay, and when a customer owes us money, it's AR. Okay, so let's go back and process all again. We sold stuff for $31, but it wasn't free. How much did the calculators cost us? How much were we netting if we had to figure out how much money we really were making off every calculator we sold? $10. But really it's not, because we're going to tell this story later in the week. We've got the lights on, we're paying our employees, we've got all those other expenses there. So we're probably not even really making $10 off these calculators, but that's for another day. Okay, so anytime we sell 2 transactions, we first put the sale down, AR, because there were terms that went with it, not cash. We sold 26 at $31 a piece. That's what we sold them for. If you'd flip this whole thing around, you'd be in a terrible bit of trouble with your accounting department. Or you as the accountants would have figured out, if you would put the 21 there, we're not doing a very good job because we're selling stuff for a lot less than what we bought it for. What's our credit when we sell something? Starts with R. It's revenue. In this case, it's sales revenue instead of service revenue. Now, I would probably count it wrong on the test if you just wrote sales. But if you just wrote revenue, I'd probably count that right. If you put sales revenue, that's perfect. So this was the sale of the stuff, but what's gone if I sold stuff? Inventory's gone. Now inventory is an asset. If I debited it, it would look like we're getting more. So we are going to do what with inventory because it's gone? It's credit, but what's our debit? What offsets the value of the revenue? It's a little 4-letter acronym. COGS is our debit. The inventory is gone. This asset is gone. It's out the door. Who took it? The customers. They didn't take it. They bought it for $31 a piece. Cost of goods sold, though, the stuff was not free. We paid, including shipping, $21 a piece for these calculators. I thought they were $20 a piece. Well, included in that is shipping. Remember, that drives the value of our inventory up. Had we, just listen for the minute, this is a little deeper level thinking. Had it been FOB destination, and we didn't have this transaction right here, had this transaction not been there, we would have made $1 more on every calculator because we didn't have to pay to have them shipped. So that's where you want to bargain and fight for that FOB destination. You want to capitalize on that free shipping. Are we selling more in the next transaction? No. Lee Book knocks on a door or calls us or whatever and says they want to return one calculator that was not ordered. They want to return something. Okay, so lots is going on here. We've got to give them some store credit. And what else is going to come back if they bring us a calculator? We're going to get inventory going back up, which is going to bring cost of goods sold back down. So we got the stuff back, and then that drives cost of goods sold down. Let's do the first half. Remember, you are not going to see revenue go down. Because remember, once the revenue happens, we leave that. We leave that alone in its little T account. Rather, we're going to offset it with a contra revenue account. We're going to leave the sale alone. We had the sale of $806. We're going to let that be. But we are going to offset it with a different account called sales returns and allowances because one calculator came back. Did they tell you it was $31? Okay, sweet. AR is going to go down because they no longer owe the $31 that they originally owed. We're going to reduce that. We have to make the sale. We're going to say, okay, you don't have to pay us that $31 anymore because you returned it. When something comes back to our store, we get the item back. $21 worth of inventory is now back. But as a result, cost of goods sold goes down. Was there anything wrong with the calculator? I don't think so. I think we just sent them one too many extra and billed them for one too many extra. So when you're selling stuff, you first have to say, okay, revenue, here's our dollar amount, and then the stuff. If we're returning stuff, we first say, okay, they no longer owe, and then the stuff's back. And if it's still sellable, we're going to put it back on the shelves. Okay, we're selling more stuff again. We sold 30 calculators this time, costing $21 for $32 each. We raised our price. Okay. Orr's Card Shop bought some, and there's terms, which tells me, did Orr's Card Shop pay cash? Nah, we let them charge it. So kind of a wham bam. We sold stuff, so we have to do 2 transactions. The first thing we do is tell them that AR is going up. These people now owe us money. And we have sales revenue for selling the stuff. Remember, we're selling at the largest price. 30 calculators at $32 a piece. We must have increased our dollar amount, our price tag, if you will. The reason we are not done with this transaction is because, yeah, someone bought stuff, but the stuff's gone. So we have to say inventory's credit. Inventory went out the door. And as a result, we offset the revenue with COGS. If you're confused with where COGS has a normal balance, let's do this. If I've got sales revenue on this last one, I see a credit. That looks like, woo, we're rolling in the money here. We've got $960 in sales. But there's that secret little COGS hanging as another account that has a debit balance. So although it looks like we made bank here on calculators with $960 in sales, there's that little silent offsetter. This is also a contra revenue account because we really didn't make that much money. 960 minus 630, we actually only made $330. And we haven't even paid all of our expenses yet. So this might look really glamorous. Remember, that's by itself. We've got a contra revenue account kind of hanging in the weeds, offsetting that. And that's why you see a debit balance, because it's contradicting, or it's a contra revenue account to what's going on over there in credit world. So if I had to go back to that first slide, I don't know what oh yeah, here. I'd even add a third that's a contra revenue account called COGS, because that offsets what's going on in credit world, that debit. So some of you might like inventory better because it's all right there, but you got to really remember what's plussing and minusing and what does that mean. Versus revenue, although this looks a little bit more messy, revenue is revenue, and then we've got these three contra revenue accounts that are offsetting that credit world. I like, from a teachability standpoint, I like this better because you can see it. Versus here, you're like, okay, some of it I can see, some of it I have to know what that means. Easy? Sure? I'd like you to try this on your own. This Microsoft Word file I gave you, just a single sheet. Remember we did 5.1 and 5.2. What I'd like you to do is try to do 5.3. It looks like we're still in the calculator buying and selling business here. I'd like you to do 5.3b. Remember, you're not going to have a journal for it, so just handwrite it on a notebook paper. We're sitting with lots of time, so why don't, as soon as I see you all kind of wrapped up, I'll go through the answers. Would that be helpful? I'll pause the recording. Eli, if you're listening, I'd pause your recording as well. Okay, so instead of regurgitating all of the information to you, I think I'm going to have you just peek, and if you have questions, stop me. But there are your answers. I see inventory on there often. I see inventory on there every time, in fact. So when inventory is going up, that means we're buying it or we paid to get it to us. When inventory is going down, that means we sold it. And in the case of September 14th, inventory is going back up because we had sold it, but then they returned. On the 12th, on the 14th, and on the 20th, we're selling, or it's an action of we sold it and then they returned it. So just know that when we sell, it's the two transactions, and if they return, it's two transactions.